Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Parmar.
Welcome to Wealth Matters podcast. Hope you guys are having great new year. January is going much smoother than expected, hopefully for you guys. Not for me. I'm going through a lot of issues on the business side, on the personal side, investment side. So I'm hoping this year smoothens out as we go. So um, I'm recording this like a week before. So as of now, all the news came from Fed, and I just wanna understand is recession coming or not? Means we thought the recession would be here in 2015. No, 2017. No, then 2020. COVID, because of COVID, the market went down for 3 to 6 months, but then it came back pretty strong because of all the money printing. So inflation did not happen. Now we have had a more than a decade of expansion. We have not seen this before because usually the recession or the compression cycle is around 7 years and maybe 10 years. And that's what has happened before, but this time it's different. So it's weird. Three pieces of news came yesterday on Thursday. And one of them, the Bitcoin ETF went live. SEC accepted the Bitcoin ETF applications. So, as expected, Bitcoin hit all 49 grand and then now retraced back to around 45, 46 grand. But that was bound to happen. And now that Bitcoin ETF is out of the way, market is also anticipating there'll be an ETF for Ethereum or ETH. So a lot of money is flowing into Ethereum, and also a lot of money is flowing into Bitcoin ETFs as well. And that's why you are seeing outflows from um, MSTR and a lot of other Mara and a lot of Riot and a lot of other Bitcoin or the crypto related shares, right, or stocks, because people can now directly invest in Bitcoin ETFs. So that was bound to happen. I think another bull market is forming, but let's see how overall economy does. So let's talk about the news. Inflation, CPI came in much hotter than expected, right? They thought that, now inflation is under control. Even government gave a hint that they are not going to raise their rates, but they may even look into cutting interest rate come May or June. And now that inflation came in as much hotter, let's see what happens. Even Fed made now comments about rates needing to stay higher to ensure inflation is tamed. And on top of that employment report, the jobless claims came in much stronger than expected. So actually jobless claims fell, right? So just looking at all this thing, you would think that interest rates, or at least the mortgage interest rates, would go up, but no. So, and I was reading about it from actually JVM's daily blog, Jay Voorhees' daily blog, and he's one of the realtor, and he sends out pretty interesting information. So, and he's saying this time it's not different. In early 1990s, they said that California was immune to recession risk because the state was so well diversified, but then California got crushed, right? And so late 90s, again, everyone thought, oh, you can retire with dot-com stocks, and suddenly dot-coms imploded, and a lot of those people had to find jobs. Early 2000s, right? By 2005, everyone thought this is, so easy. Housing is not going to collapse, and suddenly housing collapsed, right? So it's very interesting. I'm not sure what's going to happen, but personally, I think recession is coming personally, and I think recession should be here because, you can't continue to expand. There has to be some kind of contraction. There has to be some time of correction. So a lot of indicators that have never or almost never failed to predict recessions. One is yield curve inversions. When short-term rates climb higher than long-term rates, we almost always see recessions, right? And that has happened before. Tax revenues plummet. I did not think about this. So thank you, Jay, for reminding me about this. When tax revenues plummet, we always see a recession. And that is happening also. 3 months of downward job revisions. So whenever we see jobs numbers revised downward 3 months in a row, we always see recessions. And so, that's coming as well. Conference board leading index, whenever this index dips below negative 4.5%, we always see recession. It is negative 7.5% now, and it has been negative for months. Gross domestic income GDI, whenever GDI is negative year over year, we are in a recession, and GDI is negative year over year. So long story short, don't let the stock market confuse you. The Fed is not all powerful, and they did not stave off a recession. I think, again, I also thought there may be a soft landing, but more we are stalling this recession, I'm worried that, it would be bigger than we anticipate. If not, I'm anticipating at least a contraction or correction this year. So let me know what you guys think, because of course, I want to see, other people's views and see what's coming. But you tell me, recession or not?
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!